There we go.
Okay,
We're live. Title's been changed.
cool
Things
stuff.
should be better now.
Yeah, it's just logistics, no worries.
Yeah, for those who just popped on the first one, sorry about that. Did not take care of all the things I needed to, and therefore the title was wrong. So now that all that's fixed, we can actually dig into the conversation.
Mm-hmm.
Dig into the conversation. All right. So, we all good?
Yep, we good.
Awesome. So thank you guys so much for joining us. So for those who are watching, our conversation today is just going to be around how to manage your investments during this turbulent time. And joining us today are the two co-founders of Gaia Plus. I will let you guys describe what you do. So who would like to go for it?
I think Jupan can go for it.
Okay. No worries. Okay, basically, Kaya Plus is investing-centric website where we come up with investing insights related articles, pieces where sometimes we go through companies' analysis as well. Like we analyze what the company is doing, and is the company's earning money or not? Is the company's managing their money well or not? And eventually, if it's all good, should you be putting your money into such companies or not? So sometimes words or jargons inside the investing industry could be challenging, could be scary, and also the understanding of the concept of it could be also intimidating if you don't have any prior background when it comes to investing. So we are here to just craft our materials, make it available public so that anyone who is really interested in investing but doesn't know where to start, they can come on to, get a point of view from us and then eventually pick up these basics of eventually kickstarting their own investing journey. So
Cool stuff. So how did you guys started on this? Like, it's I went on your website and it's a lot of content, pretty cool stuff. Like what got you started and why do you want to do what you do?
Okay. Basically, I was the one who started off with investing like a few years back, and we had this WhatsApp group where we had a group of friends who have been who are so-called very interested into investing, and almost every day we chat about stocks, and the topic ranges from being scalpers, traders, up to personal people like me who are practicing proper true long-term value investing. So Chunbing was the one who suggested, like, if there's so much things to share, rather than just do it on WhatsApp, why don't just create a website, and rather than just share what you know just within the WhatsApp group, just share it on a website where it's available to the public. So that's where and how we got started on crafting our stuff on the internet. And as you all know today, that was how Kaya Plus was born.
Oh, maybe I can top up a little bit.
Sure.
I think comparing me to Japan, I was relatively new to investing. I pick up this skill is to make me as in a normal working individual. Beside earning from the fixed monthly income, then there's another skill for you to earn a side income. So this is, I think a lot of people also do the same. Why we ended up all here is because I think this is an era of sharing. I mean, it's not about how much you know, it's about how much you share. So when you share more, you tend to learn more from the others, be it from the question, from the feedback, from the hater, from the people who like your content. Everything is a feedback. As long as and what we understand, as in what we believe is, as long as the feedback loop is effective, ultimately we are the one who get the most because we are inside the cycle. So I think this is why we choose to start, because it's always talk is always easy, but then you just need to start your first step, then the thing will come. So maybe I can share a little bit more on how we started with the website, and then what is the approach that we did. We both like to serve MGET, SGET, NIGET, this kind of website. So how we actually started off with all this content, the first thought is, besides sharing the boring infographic, all those stuff, we typically started off with a meme. We make fun of budget, we make fun of politician, but then of course all the things that we try to do is relate it back to investment related. And then it was quite a good response. Then we found out, basically, if you want to share something, you need to make sure it's also fun. Then people get more attention, get more engagement. At the end, they will share more feedback to you. Then this is where you start to learn. I think this is something, yeah.
Yeah, I've seen a lot of your memes on your Facebook and your Instagram. They are pretty good. So thank you for, I guess, making personal finance something, or investing, like something a lot more fun to pay attention to.
Yeah.
Yeah, and I guess this is also the first time where we actually had someone who came in with a full presentation for us. So, like, I'm super excited to see what you guys have planned. So, the main topic for those who are watching, the main topic today is really how to manage your investments during the bear market. Of course, if we have time at the end, we would love to dig into other things. So, for those who are watching, if you have any questions about, I guess, you guys primarily focus in the Malaysian stock market, right? Companies in Malaysia?
Yeah, you can say so. Yeah.
Okay. Yeah. So if you guys have any questions about any like big Malaysian companies, feel free to leave it in the comments, and hopefully by the end of it, we can get some of their thoughts and opinions. All right.
Yep.
So I'm just gonna share your slide here.
Yep.
Boom. Beautiful picture.
Okay. I think this is the picture that a lot of people use during this time. You can see it in a lot of investment related page. I think maybe Jupan want to start it off. I will control the slide. Yep.
Okay, sure. So as we all know, currently we are facing the bear markets, but the bear market is the effect of it. For investors usually, or for people who are more curious, we tend to want to know why it happened. So the bear market that we currently face, it happened, I would say, out of the blue, because as of last year, US markets or other markets like Hong Kong markets as well, they were pretty much good. But okay, maybe Hong Kong is not a good example, because they were just fresh from the riots. You can say US, Europe was okay. Singapore was doing well also. But I think as of the end of December, there was this strange disease that originated from China, and eventually it caused such a headache to everyone. So as of today, we know this virus has COVID-19. It has actually made the stock market tank 20 to 30% from the peak, respectively from which market you're looking at. And also, of course, it has a sidekick. Together with COVID-19, there's the price war that Saudi Arabia is currently waging with Russia. So when you put two very unlikely negative sentiments together, that's where we are currently having the aftermath of these two pranksters affecting our investments, and also the current stock market sentiments. So I think maybe to make me go to the next slide. So,
yeah.
Of course, pandemics is a big thing. Of course, people will be very scared. I mean, look at how the government all around the world has been trying their very best to control pandemics from spreading and from infecting even more. But I think as of the latest numbers, we have reached 1 million cases worldwide, just in terms of COVID-19. So of course, We have lockdowns in Malaysia, in Singapore, in the US as well. And everyone is trying their very, very best measures to contain this virus from spreading even further. But if you look back historically, this is not the first time we actually come across pandemics. So even back then in the you see in HIV, you see in 19, we have HIV that was the currently today, just that it's not as infectious compared to COVID-19. And then down the roads, you also have your pneumonic plague, you also have smallpox, you also have Zika virus, you also have avian flu. But of course, these kinds of pandemic, it will cause market fluctuation. You can see markets coming up from their previous highs, coming down to correcting down at a huge momentum. But eventually, looking back at a very long term, stock markets will eventually go higher and higher, just because the very simple fact that we will eventually prevail no matter what pandemic comes our way, and good companies will continue to strive and survive along this period of time. So, Junping, can go to the next slide. So, knowing that eventually, in a very long term, where with the help of science and technology, or maybe with just a little bit help of lady luck, stock markets will eventually go back up on the uptrend. So, as anyone who is currently in the investing ecosystem or environment, of course, you will be wondering whether what's the best thing to do now. Should you still sell off your investments because you're currently looking at the 50, 60, 70% of capital losses in your portfolio, or should you buy more because it makes sense to buy companies that are not affected by the current bear market, right? So, so people tend to be lost because on the internet, you have your sellers and you have your buyers, and both are equally loud and vocal when it comes to voicing their opinions. But eventually, what should you do? Before really knowing what you should do, I think it's more important to ask who you are, because ultimately, who you are will determine your respective strategies going on during this pandemic or during this bear market. So, how I really like to drill down or try to make an impression of knowing what you are, who you are, is more important than what you should do. Is when we were small, we tend to play those role-playing games with multiple characters. So inside games like this, like for example Maple Story or even Ragnarok Online, you have warriors, you have bowmasters, you also have assassins. So each characters eventually have their own strengths, their own weaknesses. But eventually, if they train well, you train your character well, and you level up your respective skills, during the end game, it doesn't matter because all classes will be equally strong. So before asking what kind of skill you should do, what kind of quests you should do, you should really go back to the initial page when you are starting out your game by configuring your character looks and what kind of character jobs that you want to do. Are you simply a dividend investor who focus on finding companies which are printing money, and then eventually these companies will pay you back this money as form of dividends? Or are you looking at companies which have very, very good prospects in terms of growth, companies who can continue to grow 50% more each year, or 30% more each year, and eventually this growth will stack up and add up to the future earnings? Or are you practically a very good trader where you go in and out the market and you manage to follow or even take advantage of the price action before an unwanted price action comes against you? So at the end of the day, you really need to understand who you are, what your strategy is. Then only you can determine what you should do at this current bear market. So value investors or pure investors, they really have a different kind of skill sets compared to traders. Of course, the same goes for traders. So if you're a value investor, of course, the most logical thing right now is to find great companies with a fantastic business model, and then these companies should have very good future prospects where they will continue to earn money in their respective business sectors, regardless of what happens. And of course, this doesn't mean that these companies don't have any risk. They will still face challenges, obstacles along the way, but with the so-called historical performances of these companies, coupled with the potential management, which has the hindsight or the vision to foresee what will happen, they would already be preparing for potential obstacles that are coming to them. So after you would eventually want to target or to value the company. If this company is so good, if the potential of this company is so big, what should you do? Or if you want to buy it, what kind of price are you going to pay for it? So upon that, eventually when you buy your first company, you eventually come up and ending up with the second, or buying a second company, a third company, and eventually you form a portfolio. So having a portfolio of investments or stocks is just like very layman term, taking care of your children. So you may have 10 children in your portfolio, and each of them requires your certain attention time to time again. And if some companies are not performing or are up to nuisance or up to mischiefs, you should give them certain actions that are required. And last but not least, of course, for investors, it's always very important to manage your cash and your investment ratio. You wouldn't want to be over invested, so that current situations like this presents itself. You always have sufficient cash on hand to take up of any downturns. Going forward, if you're a trader, of course, the strategies or the concepts of a value investor will never ever make sense or whenever apply to you to make you to become a better trader. So if you're a trader, of course, you will look for counters or derivatives that are high in volatility. So you take advantage of the fluctuating price up and down to to actually make your winnings. So of course, you will be relying very heavily on the chart patterns. Of course, when to buy and when to sell. By looking at the chart, you would be more confident in making your next move. And of course, worst case scenario, if you have any situations where the price is going against your bet, then you have to have a very disciplined cut loss or take. Not least if you are a trader who relies on margins or equity financing, which means that you actually could win or lose more than what you have in your account. Then you also have to be very disciplined in handling your margin financing as well. So if you're not disciplined in handling your margin financing, you will end up losing more than what you have, and that would be very perilous and dangerous. So one of the things that we share when it comes to determining the economic mode or the business advantage of a company is some companies are just so strong and just so monopolistic that it will be very hard to challenge them head on head in whatever they do. So of course, there are also companies which just normal economic mode, normal business models where they are not the only ones in their respective field. They also have a few other competitors which are competing with them at a very fair advantage. So how we look at companies with economic mode is we can break it down into 6 categories. So as of the current scenario, of course, people will be more curious of what kind of companies to look at in the current bear market or current COVID-19 pandemic. So, of course, with the current COVID-19, you have companies whose business model is not impacted, regardless of whatever happens, pandemic comes. These companies are companies that have they still do their business day in day out. There's no impact to them. Examples of such companies would be your food manufacturers. So regardless of a pandemic or regardless of a financial crisis, people will still need you will still need to eat, you still need to drink, and even now, the worst case scenario is you have a lockdown. People will be heavily dependent on groceries. So companies who manufacture packed food stuff or packed drinks or bottled drinks would be the one not impacted. In fact, you could probably say that their sales would be positively impacted by the current pandemic or current MCO. And this is for short term. And for longer term, you could also say food manufacturers are companies not impacted in the longer term because be it 10 years or 20 years from now, humans will still need to eat and drink. And if this food or beverage maker is a listed company, you should probably be very well assured that your company's business model or the sales would be very negatively or will be not very impacted by the current COVID-19. Of course, moving on, there are companies where the sales are positively impacted by COVID-19. For short-term kind of positive impacts, you could see companies like Zoom. Zoom is a listed company in the US where people have started using their video conferencing services just because employees or colleagues cannot meet with their co-workers face-to-face, and they have to rely on video conferencing to work and to collaborate. So for companies who are gaining, but with longer term, probably companies who are like the glove makers. So glove makers, they essentially will see shorter term increase of sales, but judging by the very fact that human population will also increase over the years, and healthcare will also improve and increase also over the years, usage of gloves will also grow at a very natural growth state in tandem with the human population growth. So moving on, you will also find companies who are losers in this current COVID-19 scenario. Companies who are facing a short-term squeeze would be the tourism or airline companies because of the strict measures of controlling the spread of COVID-19. Airline companies and tourism companies have suffered badly because they don't have sales, they are not flying. But after everything is done, and after we have gone through COVID-19, eventually this would be just a short-term impact to their long-term business growth. Companies who are losers on the long term would be potentially companies that have a very obsolete business model, and the current COVID-19 just makes it worse. So we would say companies like our traditional media, who like our newspapers, companies like Star, where you see that they are losing out in terms of physical newspaper sales, and in terms of online as well. They are not as affluent or as popular among the online population or online generation when it comes to getting news. So from just looking at how a company's business model can be tabulated into this so-called simple segregation method, you would be more likely to choose a company which either is not impacted or will have a long-term growth curve 5 to 10 years down the road.
Yep, I think maybe we also can continue to talk about all this, or maybe we should start to see whether we have any question coming in from the live session.
Okay. Yeah, let's because we do have like one question here.
Okay.
So, question here is, what are your thoughts on Nestle? So I remember you guys have actually talked about. I remember seeing it on your blog that you've talked about Nestle before. If you don't mind, summarizing, what your thoughts on Nestle are from that blog piece, and then what it is currently doing today.
Okay, sure. So just for a brief introduction for those who are not aware of what Nestle is a food manufacturer, Nestle Malaysia. Globally as well, Nestle is a global food production company. they have plants all over the world, and just happens so luckily we have one of the subsidiaries, Nestle Swiss, which is Nestle Malaysia, listed on the KL Stock Exchange. So Nestle Malaysia is itself is I think the biggest food manufacturer, and they have I think 7 or 8 manufacturing plants in Malaysia, and their products range from chocolate malt drinks, coffee, instant noodles, sauces, so pretty much everything. And you also get like infant formula. So their product range is for the babies up to old people. So you can say that no matter what age range you are, you would essentially potentially become Nestle's customer. So what is my opinion on Nestle is Nestle is such a fantastic company where you see just now that I mentioned that not only they sell products that are accustomed to babies, even if you are a teenager or if you are grown-up man, grown-up women, or even if you are old woman or old man, you will still find yourself potentially being Nestle's customer. So having this kind of age range of customers makes Nestle very attractive, because no matter what age you are, they will eventually earn your money. Compared to alcoholic breweries like Carlsberg or Heineken, you would be able to become alcohol people who consume alcohol after the age of 21. So alcohol breweries will not be able to target young children, young child for their products. That said, because Nestle is such a wonderful company with such so many choices of products, it comes at a steep price. Prices, I think as of lastly, they trade at roughly 50 plus or PE of 70 plus. So it's a very hefty valuation for such a company, even though it's a very great company. I would say if you buy Nestle, chances are you won't be looking at fantastic gains down the road, but you won't be looking at terrible paper losses, or it won't be a significant investing loss should you choose to invest in Nestle. So the thesis of investing is, yes, it's a good company, but eventually, is it worth your money? Is it worth to put your money with this company with the current price it's selling?
Yeah, I think the point we wanted to make here is, I think it's quite straightforward. Throughout this pandemic, you can see Nestle price is not so much impacted. But of course, if you are the one that always in front of computer screen, then maybe you manage to get the lowest price. But then it will go back up very fast, because this is a necessity that people will always go and buy it, because they think this is the thing that required moving forwards. But what we want to say here is, during this kind of time, you should always see what is the company that might have a long-term gain throughout this period. So for example, the one that we wanted to say is, with this kind of lockdown, you can see it actually speed up e-commerce, it actually speed up the work from home culture. So this is the one that will give you the highest potential return in the future, compared to you get things like Nestle, TMB, and so on. Yeah, it's stable, but you won't be the biggest winner after that. So that's why you can see now the slide that we show here is, from the left to right is the different industry that in our thoughts that will have a different, be they are biggest loser, or they are the biggest winner. So you can see, obviously, tourism related, aviation is a potential biggest impact during this period. But then, of course, you also will know foods, medical, and so on will be the biggest winner. From this chart is simple, because it's like what is happening now and what is the impact to them at the moment. But as an investor, you should always see it from a short term versus long term. So this chart's only true during this period, but it might not be true for a long term perspective. That's why our previous slide was talking about you should always break it into short term and long term. So one good example that a lot of people talk about now, Netflix, they are forced to reduce the quality of streaming because too many demand. I should go and buy now. It's definitely will have a lot of viewership in the future. But for me personally, I think this is a classic example that this is a winner during this pandemic, but it's not going to be long term. Just think about it. Now people have time, spend time in the home, then they watch this Netflix series during this lockdown. But eventually, the lockdown might be end, even though work from home culture started, but not everyone can enjoy this kind of facility. Eventually, viewership will drop, and then this is a short-term spike. Unless you are really doing short-term trading, then maybe it's a yes for you to go after this kind of stock. But then, if you're looking for long-term, this might not be the one. Then on the other way, then you see, then you talk about long-term gain, then maybe Zoom seems like it. Zoom seems like the best stock to go after because now everyone's talking about Zoom. I do my workout session with my friend using Zoom. I do cooking sharing using Zoom. Seems like it will be the biggest winner after all. But what we wanted to share here is Zoom. Yes, they will be biggest winner, but will they be the ultimate winner? Is the question mark. Why we say so is you can see Snapchat used to be so good. They are like the potential threat to social medias like Facebook. Facebook tried to buy them, they turn it down. They think they will be winning them in the long run because they are the founder of this kind of story, limited time kind of presentation in social media world. But you can see now, Instagram story is the one taking the world, not Snapchat. They are like the one who say, thank you very much, Snapchat. You train the audience, you train the people around the world. That people like this kind of interaction, but let me reap the outcome. So if you really look up into Zoom, you might need to take a step back and think about it. Who is the one that have a better ecosystem? For example, Microsoft. Microsoft have live stream services, Microsoft Teams. And then the most important part is, beside Microsoft Teams, they have a big suite for them to serve the service. So when you have a big sum of catalogs behind you, you can create a 1+1 greater than 2 or even 3 kind of impact. But Zoom cannot. Regardless how big they can go, they are limited to video conferencing. Maybe they are very stable and so on, but this is just about it. They are limited by that sense. But Microsoft, maybe their user experience, all those things, is not that good at the beginning, but eventually they will pick up. So this is some of the thought that we wanted to share. Don't go and react immediately, even though you see now the price is attractive. This guy is definitely a winner, but you should always take a step back and think from short-term and long-term perspective, are you doing the right choice? So beside that, then why we bring up the Microsoft Team example is, even though it's obviously the biggest winner, then you should see the competitor around him or their products. Is there someone have a bigger product suite behind them? So these are some of the things that we wanted to share for everyone who wanted to take advantage during this bear market. Make the right choice. Don't just make because of you think it's the biggest winner on the eye. You see the news, a lot of articles sharing about it. Don't just see from the surface. Take a step back and think about it.
Yeah.
Cool. Thanks for sharing. Yes. I'm super big in the tech space, and I know there's a lot of coverage in the tech space.
Yep.
But it's not every day that people bring up a FMCG company, something like a Nestle, right? It's like, who invests in Nestle? Okay, sorry, it's not within my peripheral, and I think you guys have a bull case for Nestle. All right, so at least that's what I'm getting, right? The consensus is it is good in the long term. Whether it's the right price now, that's a big question mark. But yes, it has the strength for the long term, But I want to present a bear case for Nestle, right? And then
sure.
that's kind of discussion, right? Because although I never studied Nestle specifically, but I did follow companies like Procter and Gamble and Kraft Heinz.
Okay.
Right.
Okay.
So I think they are in a similar scope, right, in terms of what they do, the kind of supply chain and the kind of product development that they need to do to keep up with the food trend. Right. So you see P&G, Procter and Gamble sell down a lot of their assets to lean down their supply chain, right? And they lean down their whole chain, then that made them profitable because there was a long period of time that they were struggling. Right. So I think that is a reality that a lot of FMCG guys are facing at this point in time because everyone is scattered in old food trends. It's like whatever that our parents eat, right, probably will not be what we are gonna consume going forward. Right. And one of the biggest failures in the game would be Kraft Heinz, right? No one really eats Philadelphia cheese anymore. You know, it becomes like a once a while you make cream cheesecake kind of thing. You know, it's like so. Food trends are the FMCGs are very susceptible to food trends, and they are very capital intensive in terms of building a whole infrastructure to deploy, to develop, to research, ultimately get their product to distribute it to the people, right? So given that kind of capital intensity, I don't like this kind of business, right? But I'm curious, what are your thoughts? And because you've done your study on Nestle, how is Nestle trying to keep up with food trends and stay viable and stay competitive in this FMCG space?
Okay,
could you share some stuff with us? Yes.
Can. I think that's a very good question. Of course, you are very true that big companies or big food manufacturers could be rendered obsolete, and you've stated your examples very well, like P&G, Kraft Heinz, some of these examples. Even I would be very honest to tell you that Nestle Switzerland itself, because it's the headquarters, so they would also be, they're already in a mature market. Europe and US are the mature markets, and they are facing so-called challenges from the upcoming potential new food innovators. But luckily, we are situated in Southeast Asia, and Nestle Malaysia itself, apart from being a very strong Malaysia food producer, they are also very strong in terms of supplying Southeast Asia with their products. So Southeast Asia is also the up and coming growing regions around the world. People are a lot of food companies, manufacturers, or even ingredient suppliers are setting up shops in Singapore as their headquarters to serve the Southeast Asia region, because we are slowly growing in terms of income, disposable income increases, then we are able to afford for better foodstuffs, better quality. So Nestle Malaysia itself, although they have been in Malaysia for 50 plus years, they have their manufacturing facilities there to tap onto the potential upcoming food innovating, so-called new products, new innovations. And of course, it's a capital-intensive business. You need to build factories, you need to set up your manufacturing lines as well. But rather than just being just categorizing it as being capital intensive, then you don't look at the business. I would say that it would be wise to look further into it. How actually can this company raise that kind of money to do capital expenditures? So if you look at Nestle's profit margin, they have I think gross profit margin is around 30+%. So for every 100 ringgit they earn, 30% is the cash on hand, and then out of this 30 ringgit, they can choose to do whatever they want. Maybe they spend 10%, 10 ringgit on R&D, they spend another 10 ringgit on building the plants as well. Then maybe the balance of 5 ringgit they pay out as dividends to you. So knowing what the company does, how much is it earnings, and with the cash on hand, how could they manage the cash, and then ultimately you be able to drill down deeper to know that whether this company is able to have that sort of money to stay in trend with the market innovation. So also we mentioned that Nestle faces so-called new innovations challenges when it comes to products. So if we do a rewind back to when we were small, when we were young kids, that time Milo was just Milo. It comes in tins and nothing more. But eventually down the road, because they knew that the Milo brand itself was embedded into the sporting culture, people, when they think about Milo, they don't just think about the chocolate drink that we drink. It also becomes a symbol or something familiar wherever there's a sports-based event, even in terms of advertisements as well. So Nestle realized that Milo has become a brand which has outgrown the product itself, and they tried to implement this so-called brand effect into up-and-coming products. So you will see Milo in ice cream forms, you will see Milo going into different packaging as well. So as we evolve through time, we probably don't have enough time to have our breakfast or our meals at home. We were always on the go. So what did Milo did? they just package the Milo inside a PET bottle, ready to drink. So you can grab it on the go, and then when you are at the office or even during transit time, you can just pop your Milo, and that's where your consumption comes in. Once Nestle is able to leverage on the brand that they have and then sell you their product in terms of helping you to solve potential problem, which is you don't have enough time to eat something. So that is how they manage to stay relevant. And of course, down the road, if there's any potentials that comes up, I would say that Nestle is one of the companies potentially just within Nestle Malaysia is one of the companies that are able to take advantage of up and coming trends and to still be able to stay relevant, even though the product brand itself could be the same.
Cool. Thanks for giving that case as well. It's nice to actually hear both sides of the story, right? Because for every single company, there's always a reason for why it could be undervalued and a reason why it could be completely overvalued. But going back to part of your presentation, you were talking about you also need to, like, before you decide what to do, you have to figure out what type of investor you are, right?
Yep.
And one of those types of investor you mentioned was a dividend investor.
Yep.
Okay. So I want to pull up the screen again, and in here you mentioned financial services as potential losers right at this very moment. I'm assuming this includes your banks and whatnot. And it's true that like a lot of the banks have actually dropped in prices, but at the same time, they usually pay out a pretty steady dividend of some sort.
Yep.
So from that perspective, wouldn't this be a great opportunity for someone who's a dividend investor to start looking in banks again?
Definitely the current fall in prices are impacted by a lot of negative sentiments. I think Malaysia banks itself, they are facing another challenge because Bank Negara has granted all of us a 6 months moratorium. So in that case, if most of us choose to take up the moratorium, it means we don't need to pay a bank for a period of 6 months. And a bank is a business where they manage cash. They need to have deposits coming in and people paying their loans, and then once they have the money, then they can sort of borrow it to other. So when you are having a moratorium which caps the cash inflow into the bank, of course people tend to question. So if there's no money coming into the bank, how would this bank grow bigger by borrowing out more money? And you also talk about potentially having interest-free loans for during this moratorium period. People generally questions: is the bank able to somehow give up this kind of advantage, or to withstand the current cash outflow during these six months? So not all banks are the same. Yes, you are right. All prices of banks drop, but each bank, they have their own pros and cons, own strengths and weaknesses. So it's up to us if we think that banking services or financial services are facing a short-term trend. So we have to drill deeper and find out within so many banks, in which are the banks that could actually benefit when things turn around, when things becomes more positive. Yeah.
I think one interesting stuff that we also do some study on bank related stocks during this pandemic, because we think it's a good opportunity for us to buy, and it will be a good dividend return in the future. So one of the key thing that we see is, quite interestingly, if you talk about the PB ratio, I don't know now what is the price, whether it's still valid or not. The point in time when we do the table and do the comparison, basically the one that's still above the PB ratio is Public Bank and Maybank. The rest is all under. And then when we first do this comparison, then we see, wow, maybe I should go and buy CMB straight away, RHB. This is all under the PB ratio. Then after that, then we also do a think back, whether is there a reason why Maybank and Public Bank is, after all these things happen, they still stay above the PB ratio. Maybe Jupan, you want to share some of your thoughts also?
Yeah. So
actually, before you continue there, could you explain what you mean by stay above the PE ratio? Like, what's that number you're looking at?
Oh, it's the price to book ratio.
Yeah, price to book.
Sorry, PB. Sorry, yeah.
Yeah.
I think if you want, you can maybe, I think we have the slides in our Facebook page. Maybe you can zoom back or search our Facebook page. We have that information. But nonetheless, of course, what we did back then, we actually put up the whole entire list of Malaysian banks available in the stock market of KLSE, and we just did a very simple comparison between all the banks. And you would see that even though the majority of the banks they got sell down during this bear market, they still trade at different valuation. People tend to say that everything should be the same. If it's Maybank, if it's a public bank, if it's CIMB Bank, they are all banks. Then why one bank should be more expensive than the other? So that's where value investors' skills and curiosity comes in. So when you drill down further, you notice that big banks like Maybank and public bank, they have more money on hand, and with more money, they can manage their near-term and middle-term so-called obligations or in terms of cash flow more efficiently compared if you're a small bank. So small banks, of course, if everything is good, there's no pandemic whatsoever. Of course, they will have the highest growth potential, but we are talking about currently there is a problem or there's a big obstacle to go over. So people would tend to be more risk averse. They would also try to collect bigger banks which are more stable, which are more likely to survive any pandemic or big issues like currently. So that was where we noticed that big banks like Maybank and public bank, they are still relatively more valuable compared to smaller banks like RHB, CIMB, even your Affin Bank as well. So that is where the valuation bias comes in.
Okay, I'm just actually going to try pulling up the
Cool.
post here just so we can have a quick look and maybe get your quick thoughts on, post or I guess 2 weeks later, right?
Yeah, it's a few weeks ago.
So any thoughts about any of these banks, anyone?
I'm not in banks. I'm pretty concerned about the low interest rate environment. In a sense that I'm not concerned that the banks cannot make money in a low interest rate environment. I'm very concerned about the liquidity of the banks, whether they can handle when interest rates go back up, right? Because a lot of their clients may be over leveraged, may not be able to essentially pay their bills if interest goes back to quote unquote normal. I'm not sure if it will ever be normal again. So it's like the 5-6-7% range, and so my major concern is the liquidity issue and in terms of default, debt default when the interest rate goes up. And I'm not a dividend investor, so I don't look at banks. Sorry guys. Yes.
Nice.
Yeah. Shall we move on from banks? I'm so excited. We got so many things to talk about.
Correct.
Yes. So
Okay.
I think someone.
Sorry.
Oh yes.
Yeah. Sorry. I don't know if we're on the same page there, but we do have a question here from someone.
Okay.
RCE. So I'm not very familiar with RCE. Looking it up, it seemed like it was RCE Capital. Do any of you guys know anything there?
I just know a bit. I just know that RC Capital is one of the so-called subsidiaries that's connected to one of the big banks. If not mistaken, it's Bank, which is RC. So I think they are not really a bank, but they offer so-called financial related loans and stuff like that. So they are not as big as a bank. They are some sort like you can say they are like those small loan lenders, like which we also have some few examples listed in the Malaysian market. We have like Aeon Credit. We also have like Altexa. So these guys they predominantly handle small loans, small personal loans, They also handle hire purchase, which funds your car loan. So they are in a very small space. They don't actually go for mortgage or even business loans, which are much bigger in terms of number.
Okay.
Mhm.
Yeah. I unfortunately am not very well versed in the Malaysian market, so I have no comments about any of this stuff.
Okay.
Yeah. I when someone asked about RCE, I actually went to Google and I went to the wrong RCE.
Okay.
I went to a small pharma company in the US, in Australia. So yes, no comments from me. But I think one of my some of my followers actually, I know we have a lot to cover, but we have limited time. So let me kind of jet in a question. So some of my
Okay.
followers are asking about AirAsia.
Okay.
Right? They're asking about AirAsia. I was like, for me personally, I'm not a big fan, but same issue because capital intensive, and price
Yep.
sensitivity, etc. So
Mhm. Mhm.
I'm wondering, what are your thoughts on AirAsia, right? Because that'll be fun to hear your views.
I think we did mention that airlines is one of the so-called losers, and I would say biggest loser in terms of this COVID-19 pandemic. Of course, we talk about valuation-wise. People are looking at just purely the valuation and say it's cheap, and you are thinking that it's cheap. Of course, cheap is just the price itself. Of course, eventually everything goes back to normal. You will say the company will eventually business goes back to normal, and then they start earning back the amount that they are, and the share price goes up. But I think the major concern that we should look at is, I think as of lately there are some news where Tony Sri Fernandez is thinking or considering to getting a loan from the government. So cash flow is an issue. They still have to pay the salaries of their pilots and also stewardess. So eventually, when the company borrows money, it will be a cost, and this cost will eventually eat up potential profits, even though when things go back to normal. And even if they don't borrow money from the government and they ask it from the shareholders itself, then you have a cash call or rights issue where eventually numbers of floating shares increase your earnings per share, even though in the future will go down also because that company has not enough cash currently and they are looking to find cash. So it will have an impact in the long term down the road. And if you are, of course, if you are very confident in the company, you think you've done your risk assessment, you think that AirAsia could just weather this short-term 6 to 1 year pandemic scare, then by all means, if you are very confident, then you should take advantage of the price. But personally, I think that the current cash flow issue that AirAsia is facing is something that we should not take lightly, and we should even let everything pass, even just let COVID-19 pass, and then we look at what is the price that it's trading at, and whether once COVID-19 is over, everything's back to normal, you will still have the chance to buy the company because the company has gone through this tough period, rather than just putting your money in and potentially seeing going down even further. And that's where you make rash decisions, you cut loss, and there goes a chunk of your money.
Perfect. Yeah, I think from like the way I look at it as well is like there are many opportunities right now that people can be taking advantage of, right? And so from that perspective, there's no need to rush into something that has so much more uncertainty when there are many other things that are potentially on sale, right? So that's kind of how I'm looking at it right now. Like I know I mentioned in the past to some friends, I was like, yeah, I'll look at AirAsia when it's around 80 cents. But this is right, like, pre every single country going on lockdown, and then seeing how everything played out. So, and since then, I'm just like, yeah, I mean, I'm still interested in AirAsia, but it's not as high on my priority list versus all these other companies that I'm way more interested in right now. Yeah.
Yep.
Anyway, so we just came up to the top of the hour. So this is kind of usually the point where we wrap up. So thank you two so much for sharing so much great information. If anyone is interested in learning more about Gaia Plus, are there certain places you would like them to visit?
They can visit our website, mykayaplus.com, or they can search us out at our Facebook. So Kaya Plus. So either way, the internet is so convenient right now. We are just a type away, whether it's on the Google browser or on the Facebook search tab.
Perfect. So type in Kaya Plus in any social media or any platform, and you'll somehow run into you.
Yeah.
I think what we wanted to say here is, beside something that we share about investment, typically we will share something funny. Hope it cheer you up during this lockdown. We will use some cute cats or whatever means, whatever picture that they can cheer us up along the way. I think it's a tough time. But you still need to live it through. Why don't you face it positively? Make jokes, make people happy. Life goes on.
Yeah. Okay. Thank you two so much for taking some time today, and thank you everyone who is watching this live or a replay of this. So tomorrow we actually are doing our first real episode, I guess, on a very different type of topic. Reggie, would you like to kind of quickly explain to everyone who's still watching?
Okay, so I'm sure some of us have been affected by COVID-19. Okay, maybe all of us have been affected, but some people have been affected more drastically. So we're getting some people that have been directly impacted, by this COVID-19. So like air stewardess, fitness trainers, restauranters, to come on the show to talk about, how they're managing this thing, what are the impact that they're facing, and their friends, because they're all in that circle. So just kind of hear from the ground, how exactly are people managing their finances at this point in time, and how they're going to ride through this to come out stronger.
Perfect.
Yeah.
So thank you guys again, and we'll see you soon. Bye.
See ya.
Thank you very much.
Bye.